Hi, I'm Keith McCullough. Welcome to our first segment of Real Conversations, which is based on something that S.S. McClure did in the late 1800s, which is really having real conversations with real people who own the debate. And in this case, I'm happy to introduce you to Andrew Huszar, who's here from the Fed, actually, but also former managing director, most recently at Morgan Stanley. But he was in charge of running the Fed's mortgage-backed securities bond buying program, which is a very unique part in America's history, certainly a very unique part in the Fed's history. So I wanted to get into that with Andrew today. So with that, welcome. And,
Thank you, Keith.
And thanks for doing this.
My pleasure. Really happy to be here, and thanks for having me.
Yeah, it was really exciting for a lot of us. And I mean, a lot of us are buy-side clients,
right.
our customers and whatnot. When you wrote this fantastic op-ed in the Wall Street Journal in, I guess it was the second week of November or thereabouts, right. And really, you started the op-ed by saying, "I'm sorry, America." You didn't say it like a Canadian would say it, but that's how you started. And,
right.
and I thought that the tone itself was just this amazing tone, and in a lot of ways surprised a lot of people. So I wanted to kind of start with that. What motivated you to write this?
Well, it was my first apology to America. Hopefully it'll be my last. But really, the reason I wrote it, and it took me a few years to write it ultimately, was because I felt as if I had worked at the Fed with the idea of helping to stabilize the economy and help us ultimately make amends, or at least to redirect the economy on some level post-financial crisis. And 5 years after the financial crisis, I feel as if the structure of our economy is very similar to where it was before the financial crisis. I talk a little bit about in the op-ed about how, our banks have gotten bigger in terms of 0.2% of banks now control 70% of the industry's assets. We have a banking cartel at the top of the economy, and the underlying conditions for growth in the economy are only deteriorating further. And so my apology really came from the idea of whereas I'm proud to have gone back and I have great respect for the Fed and for the smart, well-intentioned people inside of it, I feel as if on some level we enabled a further deterioration of the situation in the United States.
Yeah, in that regard, and again, I want to get into what
right.
you still do believe that the Fed should be.
Right.
But I mean, in that regard, you really didn't mince any words, and I'll quote what Andrew wrote. The central bank continues to spin QE as a tool for helping Wall Street. Now, can you kind of like get into
as a tool for helping Main Street?
Or Main Street,
yeah.
Main Street. And now when you think about the spin, what do you mean by spin? Because a lot of people think the Fed is different things. Like, are they actually cognizant of the spin? Are you operating under the guise of a spin? Like, how did that feel?
That's a great question. So, I think if you look at what the Fed, at the tools at the Fed's disposal, those tools operate through the banking system, right? Where the Fed is ultimately only as effective as it can be through working through the banks. And so I think there's a larger public policy motivation of the Fed in terms of trying to help Main Street. But I think in that its tools are disproportionately benefiting Wall Street. And in some ways reinforcing the status quo in America in terms of what we have. I think there's where the bailout comes. There's where we've seen hundreds of billions of dollars of profits accruing to Wall Street through QE. Mm-hmm. And I think on some level the Fed recognizes that its tools do benefit Wall Street, but on some level it is trying to have this knock-on effect. My issue really is when I was there during the first $1.7 trillion of QE bond purchases, we ultimately saw that really the knock-on effects to Main Street really weren't accruing, and yet the Fed has gone on to buy almost $2.5 trillion more bonds, mm-hmm. and we have this possibility of Q-eternity, right? Mm-hmm. Which is this idea that we're going to have some bond buying from the Fed permanently, and this is a tool now that's in the Fed's toolkit, and where do we go from here?
Yeah, no, it's interesting. I mean, we would definitely, as many people who have seen our work would contend, I mean, we'd have your back on that. I mean, right. what we did was we devalued the currency, which gave America the highest food prices ever in 2012, right. the highest oil prices we've ever seen, savings rates of 0%, which are not really well communicated, but they're starting to be. Have you had different people, I think, that different studies have come out to say, hey, what has been the impact of starving savers in America with a 0% interest rate?
Right.
Is that something that the Fed even talks about internally, or is it something that you've kind of analyzed externally as having a quantified impact?
Yeah, I mean, so if you look at, so what has the Fed been doing basically? It's been buying bonds for 5 years now, and
it's a long time.
It is a long time, and over $4 trillion worth at this point. And you've had these huge benefits in terms of hundreds of billions of dollars of profits for Wall Street. This idea of a massive wealth effect, which I think we're seeing, the stock market up more than 150% since QE started. And yet the average American really isn't benefiting substantially from that. You have what you had just mentioned. McKinsey about 2 weeks ago put out a study talking about the benefits of QE and the costs. And one of the costs talked about was this idea that retirees have lost about $360 billion of yield. And basically, it's really funny. A couple days after I came out with the op-ed, I was in the gym and I saw my neighbor, who's a retiree. He used to work at JP Morgan. And he knew I had written this op-ed, and he said...
Was he smiling still?
He was smiling. And so he said,
a lot of people
not at me, but more generally.
A lot of people were, though. I want to make sure people know that. Because,
Yeah.
there's a whole edifice of storytelling that surrounds, don't say anything negative about the Fed, don't say anything negative about the government. And you're really, you were brave in putting that out there. And a lot of people do. Back what you had to say.
Oh, thank you. Yeah. So my neighbor basically, I said, what do you think about the Yellen hearings? And he said, well, I really hope she gets in because my 401k needs the help. And we're in this point where it's a really bizarre point where we're pushing retirees into trades that they really shouldn't be in, and we really have and to the larger point, I do believe in government. I worked in government for 9 years. I believe in the Fed. The point is, I believe that there's smart government and there's not smart government. And I think what we're doing now is not smart government.
Well, in that regard, could we take a step back and look at and contextualize that point?
Right.
Because you're not an anti-Fed guy.
Right.
It seems like you're more anti-Fed what the Fed is doing right here and now. In your op-ed, you said, this is my dream job. In almost its 100-year history, the Fed has never bought one mortgage bond.
Right.
And here you are, you're buying trillions worth of mortgage-backed securities.
Right.
So what is your problem relative to what the Fed is supposed to do and what they're actually doing?
So just to put it, give a little context. I graduated from Columbia University with a JD MBA in 2001, and I worked at the Fed for 7 years. 5 of those years was as an in-house lawyer. Actually, was supporting the 30 or so financial services businesses that the Fed has. Then I was a regulator for a couple of years, a bank regulator, running a team that looked at financial risks on banks' balance sheets. And that was the point at which I left the Fed, which was basically in very early 2008, when the crisis had already started on some level. And I had got to a point where I was, excuse the pun, fed up with the Fed. I just thought that it had lost.
So you were fed up with the Fed before you actually going back to actually work to help the Fed.
Exactly, because
Which is interesting.
I felt as if you look at what the Fed has been doing, I think even going back to the latter part of Alan Greenspan's tenure as chairman, you had an excess of deference to Wall Street, and this idea that by trying to actively stimulate credit, it could somehow help the underlying economy, and the Fed actually keeping interest rates artificially low so as to stimulate credit, as well as what I thought was somewhat deferential regulation and not pushing back hard enough on Wall Street. And so I left the Fed and went to Wall Street and then watched as the Fed started talking about its mistakes and talking about the need for change, and we had a larger conversation in the country about a need for change and maybe tweaking the model that we had. And also, again, I have great respect for the Fed and great affection for a lot of people inside of it. And so when I did get a call to come back and help, that was really inspiring, and I really wanted to and especially me being entrusted with this idea of managing a $1.25 trillion stimulus program. It was a mind-blowing, exciting experience.
It would have to be for anybody.
Yeah, I mean, it was an honor. It was really, and so this is, and so really kind of my apology and kind of why I wrote this is because I believe ultimately we let that opportunity for adjustment pass, and what we've done instead is we're basically continuing to paper over literally our problems in terms of...
Well, basically what we've doubled down, and it looks like we could double down again, even though some people don't fundamentally believe that.
Yeah.
Because you have this ongoing debate in the country versus what the Fed should do, or should have done, versus what it is currently doing and about to do. Now, there's a lot of people that are currently debating that right now.
Yeah.
Will the Fed taper in December? We don't believe that the Fed's going to taper in December.
I'm right with you.
You're right with us on that.
I'm right with you.
So you don't think the Fed's going to taper at all in December?
First of all, I think QE I think the market has consistently overestimated how quickly the Fed's going to stop, right? The Fed was talking about, when I was there, in as early as 2009, you had Federal Reserve presidents talking about the idea of not only stopping QE early, but selling bonds. Right, and you had economists on Wall Street talking about sales, raising rates. I mean, we've got this wrong repeatedly. But I think practically speaking, the Fed will taper because there's pressure on the Fed to taper. I think that's going to be a minor taper. We're talking about 10% tapering,
but
right?
Not in December and probably not in January.
Yeah, well, definitely not December because you have end of year market liquidity. It's low. I mean, what's the?
This is what I can't understand.
Yeah,
I don't know if the manic media is trying to make a headline with this, saying that the data supports it. But the bond market is effectively closed.
Right. People are on vacation.
So no taper in December.
And also, let's take a step back. We have a leadership change going on in the Fed, right? I mean, how is Chairman Bernanke going to oversee what we saw last summer? Is going to be a bit of a bumpy ride here. I mean, it's going to have to be Chairman Yellen who does this.
Yeah.
And so I think she's going to be in that seat before there's a taper.
Well, in that, let's just kind of play this out. Because if the Fed doesn't taper in December, and then it's a debate, and it's a debate about how she communicates it, how she executes on it.
Right.
Given what you also wrote, which is, you basically left the Fed at the end because you realized, quote unquote, this is from Andrew's op-ed, I realized the Fed had lost any remaining ability to think independently from Wall Street. Now, to me, that means that basically the Fed is hostage to the market. So if the Fed doesn't taper and the market starts to go down, what's the probability of a taper?
Right. I mean, I think that's
stock market. I mean.
Yeah. I mean, I think we saw last summer. I think that played into this decision even in September, October. There was a real chance for tapering there, and they pulled back.
So you think that? I mean, that's precisely what you mean by that. The Fed is not independent. They are politicized because basically they're hostage to markets.
Well, I think there's a larger macro point, which is to say that if you look at the Fed's balance sheet, right? The Fed balance sheet before the financial crisis began 5 years ago, or before Lehman, it was basically at $800 billion. Now the Fed balance sheet's at $4 trillion. So you have this idea of the Fed expanding its actual foothold in the market, and let's be honest, the FOMC is ultimately a set of economists who do not have practical market experience.
Really?
So you have the Fed basically relying, in that it's more and more in the markets, you have the Fed more and more relying on expertise from hedge funds, Wall Street executives, and soliciting advice. And so those ties are very insidious, unfortunately, and the Fed, in that it's becoming more and more in the market, has to be more sensitive to the market. That's inevitable. And so I don't think it's I don't think it's ultimately a complete loss of independence, but it is this idea of wanting to do the right thing and who the Fed's talking to, and ultimately the fact that the Fed now does own basically 10% of the U.S. housing market. It didn't own it 5 years ago, and so it has to understand how the MBS markets work and other markets.
Well, let's go through let's go through some market structure in that regard. I mean, the Fed owns MBS is 13% of the bond market.
Right.
And for all intents and purposes, the Fed is anchored this part of the market in a place that doesn't really trade, as far as we would say, and our clients, institutional clients would say this too.
Right.
It's effectively a one-way market where mortgage-backed securities are trading at a 50 basis point spread to the 10-year bond yield.
Yeah, huge technical pressure.
How does the Fed think about that technical pressure? How does the Fed think about how it ends, how it starts to go the other way? Have they thought this through, or does it just scare them, and that's what really paralyzes them when markets move?
So, I think it's really interesting because you see a lot of technical conversations about how the Fed thinks about what the Fed's thinking, and I have a different take. And granted, I never was at an FOMC meeting. I wrote some memos for it, and I led a team that wrote a bunch of memos. But you
were in charge of manning the desk.
Yeah, I was the execution guy. Yeah,
because you have these Washington wonks, or
right.
these, we would affectionately call them Keynesian group thinkers. I didn't say that, but you have Washington, then you have the guys on the New York desk.
Right.
And you were on the New York desk.
Right.
So how does the Fed actually think about the technicals of the market?
So I think the overarching strategy comes from a different place, which is this idea of portfolio balance theory, which is this idea that the Fed's trying to take out a certain amount of stock out of the market and drive up the remaining prices of everything there, and there's benefits both to lower credit costs as well as to hopefully some sort of wealth effect.
Right. It's a theory.
It's a theory, and a theory that I would argue is not working that well.
I'd concur.
And I think the Fed really, as it's thinking about it, it's looking at the employment picture. Let's take another step back. The Fed ultimately has a dual mandate, right? It has this idea of price stability and has the idea of full employment. And so the Fed is looking at what tools it has at its disposal, in that the rest of Washington is completely gridlocked, and the Fed does feel like it's the only game in town. The Fed is thinking about how can we actually help. And so the way the Fed's thinking about it is, and QE was this idea, let's go in and actually take stock out where we can and drive up prices in the market effectively. And the MBS space was a secondary space where the Fed could play and actually wouldn't have to buy as many treasuries, even though now it's buying about 70% of issuance, which is great, but ultimately the idea was, how can we invest our money into the market effectively? And so where I think that's still driving the Fed's thinking, principally about how far can they take this without blowing up the markets effectively, and of course they worry about technicals. I mean, if you saw taper, and this is a stock market example, but we saw $5 trillion of equity implosion when Chairman Bernanke talked about a taper last summer, right? So they're clearly aware of this idea of knock-on effect to financial market functioning. But I think they're still worrying first and foremost about how can we help employment, and that's really the conversation you would be hearing, I think, in the FOMC principally about.
Which is kind of interesting, because if you look at just that unemployment rate, and I think that the Fed made a huge mistake in what they always do, which is forecasting. The Fed's forecast on growth is wrong about 71% of the time.
Right.
So when they forecasted that unemployment wouldn't hit 6.5% till 2016, 2017, boom, all of a sudden you get some economic velocity in the economy.
Right.
You're tracking 50 basis points away from that. The unemployment rate's currently 7%. And here you are. So, I mean, it's in our model, it's structurally impossible to get to 5.5%.
Right.
So do they have to actually start to recreate the narrative, change the rules, change the goalposts on what is the new target? Is it lower than 6.5 because we're too close to 6.5?
Right.
Is that part of their fear?
Well, you are seeing some people talk about GDP growth now, and sort of, and let's be honest, the unemployment rate is a bit of a misnomer, right? Because we have a labor participation rate that's back to 1978. So
which is confounding as to why the Fed would create the biggest bond buying program in world history with that target in mind.
Well, I think this is, and President Evans is a huge advocate of targeting. I think what you're seeing is an FOMC that is not of one mind. You're seeing a lot of different theories, a lot of different strands of arguments, and some of them are making them up to the chairman, and it's ultimately a political discussion. We have a committee deciding a very sledgehammer of a policy, and so
that's what you have a problem with.
Yeah, and so this is one of the issues with Fed transparency, is the idea that transparency may not necessarily be a great thing, in that you're just seeing how the sausage is being made effectively, and so. I think you're going to keep on seeing an evolving narrative, but I think ultimately what you're going to see is continued bond buying, and maybe at some level a taper. But
so irrespective of the data, irrespective of a 3.6% GDP growth rate, irrespective of a 7% unemployment rate, you're not going to see a December taper. And moreover, the minute that markets start to shake, the Fed gets very much worried. So you get this George Soros would call this reflexivity. So markets start to basically do more of what they're doing. So let's just, if you were to play that out, and people were to say, okay, look, a small percentage move in the bond market creates a large move in terms of capital losses.
Right.
And then you get capital losses. What happens? People pull their money out. It's called outflows from the bond market.
Right.
Then outflows start to perpetuate more outflows.
Right.
What does the Fed do then at that point? Because at that point, they're not in control of this at all. Do they think of that whole behavioral psych?
So this is the catch-22. I think you're nailing it. So the catch-22 is the more you buy, the more it maybe helps, right? I mean, you can't...
Theoretically.
And listen, you can't pour $4 trillion of liquidity into the markets and not see some knock-on effects, right? I mean, let's say the top 10% of, 10% of Americans own 90% of the stocks, right? So those 10% are doing super well.
Right.
Banks are having huge earnings based upon, part of it based upon investment holdings. So there is some benefits, but the reality is, the more you buy, the deeper the hole you're digging for yourself.
Right.
And this is my whole point about
people don't understand that. Though.
Yeah, and so when the Fed starts, and that's why I think the Fed will throw an olive branch at some point to the idea of a taper, and we're going to see it. But I think,
but it won't actually be a taper. It'll be the first throw an olive branch.
Exactly.
Like he at this point refuses to acknowledge that he even knows what the word means. So it's a process.
It's a process, and the point is you're going to have to look in the market's eyes and not blink.
Exactly.
And that's a hard act.
Well, maybe that's one way to kind of wrap this up, which is, like at the end of your op-ed, you said plainly that this is basically a too big to fail policy.
Right.
So if the policy is too big to fail,
right,
and all those who have been basically crowded into investing into the policy, so you bought gold, you bought bonds, you bought mortgage-backed securities, which you're never going to be able to get out of.
right.
If the policy is too big to fail, then isn't the bond market too big to fail?
Well, I think that's the point is that we've had a progressive expansion of who's too big to fail. So I agree with you. And if you look at where the Fed started, right? So in my mind, we're talking really part of the issue is this idea of an activist Fed, a point at which the Fed got to a point where it started trying to compensate for a lot of the underlying dysfunction or in Washington, as well as, unfortunately, a gradual deterioration in the conditions for growth in America and a backing up in the health of the median American. Today we have the median American back to 1995 in terms of income, right? So we've had this real decline in terms of and the Fed under Chairman Greenspan first, raising rates or lowering rates 14 times, around LTCM, around Y2K, around the dot bomb, then sort of raising rates too slowly. And so from 1998 to 2007, you had the amount of consumer credit in America double. And granted, I'm not going to say the Fed caused the financial crisis. There were a lot of things, but the Fed policy helped juice the conditions for that. And then now, post-financial crisis, where we had this idea of first trying to help banks rebound so as to stimulate credit, and then we had banks actually not lending, and so now we have this idea of the Fed trying to pump up markets to create a wealth effect so that it would trickle down to the average American. We keep on having these unusual, unorthodox policies that are just digging a deeper hole for what is a fundamentally broken underlying picture, or at least a deterioration of picture. I talk a little bit about the U.S. economy today. We are 40 years ago we were first in the world in college graduates. Today we're 14th. 10 years ago we were 5th in the world in infrastructure. Today we're 25th. 5 years ago our economy was first in the world in competitiveness. Today we're 7th. So what we're doing is we're trying to paper over this issue. We're trying to create these unorthodox policies to fix what is ultimately something that needs to be fixed much more fundamentally. And I would argue, and one of the things we're seeing is we're seeing a huge amount of complacency in America based upon it, whether that's within the market, those who are excited about where the stock market is, or whether that is among a lot of folks who are saying, listen, the rest of Washington's broken, so the Fed just needs to be doing something.
Yeah. Well, I think that's one of the major points. There's really a mediocrity in terms of how America considers the risk, understands the risks, analyzes the risks, and thanks again for coming in to talk about this, because again, it's a real conversation, and that's what we're trying to have here about a real issue that most investors have. So hopefully we can bring that back to life and do this over and over again. I think Andrew would be a fantastic guest to have back. Because again, I think we want to get smarter in this country. We don't want to get a little bit less smart, and that would be putting it polite. And on this topic of being too big to bail or having a policy that's too big to fail or a bond market that's too big to fail, I think that most Americans would consider that a very negative thing. So with that, thanks for your time. If you have any questions, I'm at Keith McCullough. That's my Twitter handle. And Andrew's also on Twitter now, so if you want to follow him, it's at Andrew Huszar, which you can see here on the screen in terms of how to find him. Thanks a lot.